Good afternoon, everyone, and welcome to Between the Lines Live. My name is Vanessa Rader. I'm the Head of Research at Ray White, and today I'm joined by a panel to talk about all things kind of small commercial. So I'm joined with Nathan Moore. Nathan is the Director of RWC Bayside up in Queensland, and we've got Ryan Trickey, and Ryan is the Managing Director at RWC in Glen, Waverley. Sorry, got my mouth, muddled up. But so two markets that you guys operate in a space where there's an awful lot of kind of smaller transactions, smaller industrial, retail, office. We'll go through all of those. But what we've seen in the current marketplace is that while volumes for commercial property have come off, they've come off for the last couple of years. However, that smaller part of the market, say sub 10, and even more obvious, the kind of sub 5, sub 3, even the sub $1 million market is still trickling along really well. Like the volumes are quite high, a lot of activity still going on. So you guys are still really busy, a lot of activity happening. So really want to kind of dig into why is that happening, which markets are doing the best, and what's happening. So it's an interesting time. So let's start with industrial. So industrial, probably the asset class that everyone's been most excited about over the last few years. Whole lot of institutional investment into the class. Saw it removed from like a dirty asset, as I remember writing plenty of pieces about it, being quite an asset high yielding, and it's certainly turned a corner. So why is there still so much interest, particularly in that small end of the market, for industrial? Might start with you, Nathan.
Look, Vanessa, I think it's largely price point driven. We see a lot of product, strata product in particular, that transacts below $1 million or very close to $1 million now. That's a relatively affordable price point now for a lot of small businesses. And when you factor in the ability to leverage a self-managed super fund, we're seeing owner occupation as a really big driver in that space. Incredibly big driver, probably 40% of transactions.
Wow.
In that sub $1 million category in particular are self-managed super for owner occupation.
Wow. Are you seeing some of the...
Probably, we're contrasted that, perhaps it's a Melbourne thing, but the rigorous regulation around self-managed super, particularly in Melbourne, to get the fund set up and everything, we, at a time, probably 5 years ago, saw very similar statistics to Nathan, but as a result, I think, of the costs and regulation involved at that price point really compresses the dollars you get out of it, even for an owner-occupier. So we're really probably seeing a divestment away from those residential assets at circa $1 million or up to $1.5 million, with people saying, hey, what can we buy in commercial? Granted, we've got a bigger deposit threshold. However, that deposit's often being generated from perhaps some increased equity in their home or residential investment, whereas rolling it off into a perhaps simplified tilt slab, low maintenance, popular commercial asset has proven to generate that momentum that maybe we're seeing in that sub $1.5 million market. They're the two big things. Expense to run super, so we're not seeing a lot of self-managed super, but we are seeing a lot of money moving out of that residential market in Victoria.
So with the owner-occupiers, so why are owner-occupiers jumping into these sort of assets? Is it because obviously industrial has enjoyed rental growth?
Yeah.
Like there's the compression in terms of this limited supply, vacancies remain really low across both of your markets. So is that really been the catalyst, people just looking to protect their business and have some certainty over their kind of occupation costs?
That's a key issue. I think in Brisbane we were seeing rent escalate at, really market rents were lifting at about 10% a year for 3 or 4 years, and they're very significant increases. So that put a bit of fear into people. The only way they could cap that moving forward was to buy the asset and control their occupancy cost. The second part of that, and we were talking about this earlier actually, is the cost of fit out now. It's a if you can get trades at the moment, South East Queensland is under an immense amount of pressure with all the infrastructure projects that are underway. But if you can get trades, it's expensive to do a fit out.
And to commit to a timeline too.
So I think people are very definitely looking at if I've got to spend $50 or $100 or $200,000 on fit out, we may as well try and do that in something that we own.
Yeah.
And then it's an amortised fit out cost over a much longer period.
Yeah, that makes sense. So investors are probably more prevalent in your market, Ryan. So are you seeing them come from a far afield, or are they local buyers? Are you seeing investors jumping around from other states, or?
Yeah, I think Victoria holds remains an opportunistic state, particularly with some of the pressure that we've had from local governments, state governments, interesting, we'll call it taxation challenges. Perhaps we might touch on that a bit later, but the Eastern Seaboard has seen, we had an auction only last week where we had bidders, 3 bidders from interstate, 2 in Queensland, 1 from New South Wales. So they still see that sort of market as something that hasn't bottomed out or is probably close to it, and they're now saying, hey, that's an opportunity. What does my yield look like in 5 years? If you've got the money, there's money to be made.
And so are those people buying it today based on a yield, or are they just looking at what that's going to look like into the future?
Yeah, I mean, the yield's one thing, but I think that highest and best use, or perhaps that value add, maybe underlet, to your question about that owner-occupier market, we are also seeing that owner-occupier market play because they don't want to be in a situation with a finite asset that they can't, the fit-out cost is one, controlling the cost of occupancy, but the worst-case scenario is actually I've got nowhere to live. I've got nowhere to live. My business has got nowhere to live.
Yeah.
So buying somewhere secures you that or gives you that security.
How about vacant assets then? We're talking a lot about in kind of investment. Is that kind of opportunistic kind of value add piece that you were talking about?
Yeah, we call them just, and Nathan and I chatted about this only over the weekend, and we were talking about distressed vacant assets, but you have to have a strategy there. You can't come to market or the bank and say, hey, we'd like to borrow 60% or perhaps 70 or 80% if you're so inclined. They go, well, where's your income? What does that look like? So we're doing a huge amount of work with some of these buyers to say, it's a great property. Here's your cash flow projection or trajectory. And we're going to the bank with heads of agreements. I mean, we only did one last week where we went to the bank and said, it's a pseudo-government medical tenant. Here is a heads of agreement. We hold a deposit in a trust account. Here's the receipt. And the bank have nearly gone, okay, we see that's the conversation around that risk profile is far more in the purchaser's favour than it was without that heads of agreement, without that prospective tenant. So.
And Nathan, are you seeing a lot of kind of local buyers like looking for those sort of opportunities, or are they coming from all over?
No, principally they're locally based. Yeah. It's really parochial. I think Southeast Queensland is a bit disconnected in some areas, and that has really caused these regional centres to sort of pop up, and I think people are very comfortable in a particular regional centre and they'll pop their money into that. Don't underestimate the value of being able to drive past it and go, yes, I own that.
Yeah, I feel like
it's eyes on the prize.
I feel like a lot of those kind of private buyers, high net worths in particular, they like to, where they
eyeball
live.
it.
They like to be able to drive past it. And I always tend to think also when you see those investors back into the market, they've seen that turn. We talked about kind of the turn in the market as the yield play now, something that everyone's a little bit more comfortable with. When you get those privates in the market, they're usually pretty good at spotting their own market. Is that a fair comment?
It is, but I also think when you're talking about those lower price points relative, so $0 to $3 million, there's actually a lot of cash still in the economy, and they're not necessarily looking at an immediate yield play or even a 12 to 15 month yield play. They're able to go through longevity in a market and understanding that market. They're able to look at an asset and go, yes, that actually represents reasonable value now, and time makes everything better, right? So if they're not under pressure, they can carry it and work with us around rent increases or refurbishment programs, cosmetic changes, those sorts of things that will organically add value as time marches on.
Yeah, so industrial, that's like, it's a really interesting part of the market because we have seen kind of that over $10 million space. Like the depth of market there is pretty shallow. There's not an awful lot of transactions across both of your markets, and in Sydney either. It's certainly has changed. So it is the era of this kind of small investment. Let's move on to retail, because retail's a real interesting one. Retail, a lot of people, really discounted retail, bricks and mortar, the end of death of bricks and mortar. Everyone's going to go online, all that sort of stuff. However, this year, like talking on the bigger end of the market, we've seen a lot more kind of shopping centres transact, a lot more kind of neighbourhood convenience type centres, because, we're having this huge population growth. We're not seeing, new retail being built. and people still like to, services in particular are pretty key. Can't cut your hair online, or you could try, but probably not a great idea. And yeah, so anything supermarket food based usually seem to be doing quite well. So has that kind of that strength in that bigger end of town, has that trickled through into kind of more maybe your strip shops that would fall in that smaller kind of category? Nathan?
I think so, Vanessa. I think for a lot of strip shops are actually quasi-professional spaces as well.
Your
so
services.
it is switching in between retail and professional.
Yeah.
So that's added a bit of depth to that market. And in a lot of cases, there's only so much main road frontage that's available. So you're not seeing massive expansion of that type of product, which for us is putting a cushion under values. It's putting a cushion under rents. Some of the really discretionary retail uses that popped up during COVID or just post-COVID, when there was a lot of discretionary money floating around in the economy, I think some of those are under pressure at the moment. Some of the takeaway food uses that were probably a little bit funky at the time, some of these gourmet burger places and things like that, those types of operators are coming under real pressure.
So is it still like an occupier? Is that similar, or is that all mixed?
No, a lot of that is actually more investor driven. And provided the tenant demand can be demonstrated, they're still transacting at a pretty good yield. And
over in Glen, Waverley, you've got a pretty vibrant street.
We're very fortunate to have a really strong retail market. That took an absolute pounding, obviously, like many of them did for a period there. But the bounce back, we were pretty optimistic about it, and I was probably not as optimistic as we could have been, because the reinstatement of really good rents and really good performing tenants happened very quickly. But we break that asset up into, or that category up into primary, secondary, and then tertiary. So we sort of look at our primary strips, and again, we're fortunate enough to have a lot of them, but their vacancy rates are significantly lower than probably we've seen for some time. There has been change, business is selling, but if they haven't made it by now, if they've made it by now, they were going okay anyway. The ones that didn't make it have already not made it, and they've moved into the ether. The secondary retail, or what we sort of call that destination retail, think bike shops, think Gelati, think Australia Post, think these sort of, you go there with a vision to purchase or get a haircut, or there's something, they're going really well too. Yeah. They're a really exciting space for us, and that's that sort of $500 to $2 million space. But then you get into the tertiary retail, and that's the strip shop with only 5 to 8 shops, 10 shops perhaps. There's no anchor tenant. They're struggling. And that's that increased cost of living, increased goods. The businesses, the quasi-businesses that were doing okay because they're only paying $25,000 a year during the last few years, that rent's now crept up because of the rest of everybody's costs, but their cost of goods have crept up. So everything's crept up, but they haven't got the foot traffic, they haven't got the anchor tenants around them to assist them and get those sort of things happening. That's an opportune space for that clever investor to go, hey, I'm going to go in and do a refurb and repaint it, or I'm going to put a grease trap in because it didn't have one, or I'm going to put a laundromat in there because there's not one in a 5 kilometre radius. So they're the strips that we're seeing probably the most transformation, but primary and secondary, we're really pleased with that activity. It's going well.
And that mix, like you mentioned, you've gone away from that kind of clothing, soft goods, all that sort of thing, because people can go to shopping centre for that.
Correct.
Okay, so it's more kind of service-driven.
It's that last mile.
Food as well?
Food definitely, with the rise of Uber Eats and Deliveroo, and I'm sure there's a number of other ones that I don't know. But yeah, it's you see these guys out the front of a pizza shop on a Friday night. There's 4 or 5 people waiting for pizza. There's 15 people dining, and there's 3 guys on motorbikes or efficient cars waiting out the front with their big boxes, because the meals are at the people's doors in 10 minutes.
Yeah, it's an interesting time. Like retail. So much more confidence, and funny that you mentioned the laundromat. I don't know, in Sydney there's so many more laundromats
popping up, aren't they? Yeah.
I was trying to work this out. Just is this I don't really know. She's at a share house situation, like with the apartment market and with the housing market so kind of hot, particularly in Queensland, New South Wales. Is the need for, I don't know.
Look at car washes. Car washes the same thing. I mean, you haven't traditionally got your driveway out the front to wash your car. Yeah. So these quick washers and turbo washers with the guns, they're popping up all over the place as well.
Oh, that's an just interesting comment. Well, I had been thinking about that. New one just opened up not far from me. So anyway, so yeah, that's the retail market. Where's the opportunity? So the opportunity is finding those kind of tertiary, get the uplift. And how about is there a reuse piece in that? Are we seeing kind of retail turn into quasi medical or?
Medical's probably a space we've had the most success recently in terms of helping our owners and new investors come into the market, where you've got beauty, hair, nail, some of these service-based industries, injectables, again, very popular, but even just your GPs. The health and the awareness around people's health is getting more and more front of mind. I mean, every other night on television, there's something to do with how to live longer, or get scanned for this, and we're certainly seeing that. Medical's good.
And I'll just kind of throw something there, because the retail numbers show that we like spending money on alcohol. And alcohol numbers are actually pretty high, so that would suggest to me that kind of those standalone Dan Murphy's or those sort of kind of liquor store assets, I know that they're pretty hotly contested when they do sell. We're seeing a bit of interest in that, or does that bring a whole lot of issues regarding insurances and things? But still an appetite? Not seeing much of it in your market?
No, Queensland is quite regulated around detached bottle shops, so there's a lot more control in place, I think, in terms of where they can go and how far they can be from their general licence hotel. But they'll typically form part of a neighbourhood complex.
Okay.
That you very rarely see a standalone, and the big liquor barns, the big Dan Murphy's as an example, or the First Choice, have to be on the same premises as the pub.
Okay.
So it's a little bit of a different kettle of fish there.
Okay.
And probably a little bit the same with us. I mean, we don't see huge volumes of them coming to market. When they do, they're hotly contested. They do sell. But yeah, those standalone bottle shops are. They're normally very close to something that anchor tenant that's going to help them carry on.
Co-located well. Yeah.
So what about office? So office has been the most terrible asset class, just quietly.
Stats don't lie. Yeah.
Stats don't lie. The Property Council just brought out they brought out numbers not too long ago. They're the numbers that everyone looks to each year, and we still see, particularly in the CBD locations, vacancies still remain really high, and a lot of the suburban locations are actually really high again. Queensland's probably the only market that office is probably looking okay. I don't even really want to talk about Melbourne, because it's a hard trot for the Melbourne office market. But in the suburbs it operates a little bit differently. But have you had much success with your kind of more local office market?
We've had no discernible issue actually, and in fact, obviously our core market is 30 minutes out of the Brisbane CBD, so it probably got stronger during the course of COVID, as people they were forced out of the CBD offices, and they didn't want to work at home, so they took an intermediate type of a facility. There's definitely a two-tier market appearing, and a lot of that's surrounding things like disability compliance and availability of car parking on site. If those boxes can be ticked, it's sort of the stock walks out the door. There's no impediment to that at all. But again, typically, a lot of our product is ground level or maybe two-story building. We're not talking a high-rise.
Yeah.
So it's got dual purpose. And you'll quite often see there'll be some sort of a retail application on the ground floor and maybe professional services above. So the appetite for that remains strong. Again, if it's well located.
Are you seeing more of sort of gymnasiums, Pilates studios, some of those kind of health and fitness uses going in under these buildings to sort of bring people, not bring them back, but it's a tendency to go, hey, that now works because the rent's been compressed. I can take my 400 or 500 square metre pad site because I can now afford it.
Yeah, again, we haven't seen a real negative impact on rent, actually. It's held the line fairly clearly. It's those uses, or the lifestyle choice uses, have become more prevalent as people are taking care of themselves a little bit better. Present company excluded.
It's a strange space for us because a number of these, even the smaller, say maybe not 50, but 100 to 200, 300 square metres, they're often sort of 3, 4, 5 year leases. They're all just starting to come up now off the back of that sort of challenging time where we've gone through this pivot. So it was never going to come straight away. It was always going to come off the back of when you can appropriately get out of your lease or your commitment to your landlord. And we're now doing a lot more reviewing of those rents and trying to instill in owners that perhaps holding that tenant at a capped rent or a similar rent, or let's go through a rebuilding process. Because once you start talking about agency costs, humble agency costs, marketing costs, vacancy costs, incentive
Legals,
costs, legal costs, all of a sudden, to go and see a 10%, 15% reduction in the face rent that you're getting, that you've enjoyed those increases over the last 4 or 5 years, it's far more expensive to go and lose your tenant to get a lower rent. And it's a real education piece at the moment.
Do I dare mention the taxation issue, which makes it even more challenging?
It's compounding, particularly with those sites that have maybe a higher or better use. And I think that's really impacting some owners that go, hey, I've got a wonderful piece of real estate, but can I weather this massive increase that we've seen on some of our land tax notices down to Victoria? And I have no doubt that people listening to this are sitting there going, is it worth holding this asset? There's always the better days ahead, but it's a challenging time for some owners because you've been dealt a card that you don't really have a say in. The hardest part is if you've committed to a deal 12 or 18 months ago that was already kind of a bit line ball because we'd come out of a difficult time, you're then sitting there having to stomach a further bit of pressure that you weren't ready for, and perhaps cash flow wasn't ready for either.
So I know we've certainly seen in the residential side of the market a lot of investors kind of jumping out of that kind of Melbourne market with pressures from land tax. Are you seeing any sort of more discussion or a bit more of an increase in kind of assets coming to market? Or
I think people are being more creative with what they're looking at. And again, Nathan and I were chatting about this at a personal level. I'm changing what I'm doing as an agent with my personal finances in the assets that I've invested in, my family's invested in, because I can't make sense of them, but I can make sense of other real estate. Real estate's still my favourite place, but you need a direction and a strategy with the property. You cannot passively sit there and just sit idly. And the ones that I had were fairly passive, and now I'm saying, hey, I'd actually rather go and put in the work because I can see upside, but there's got to be a value add piece, as I mentioned earlier. Owners that sit there and go, hey, Ryan, I really like the property. Tell me what happens next. And I think that's the key to the discussions in Melbourne at the moment. Real estate's still great. I mean, it's a wonderful market, but there can't be come and buy this on a 4% yield, a 3.8% yield, and we all sit there and enjoy that when your bank's look at the new competitors in the market. I mean, you can put your money in a term deposit for 5.5%. We've got to have an answer for that, and that answer is value add. That answer is a higher and better use. But then we're sort of balancing the fit out cost. We're balancing all that.
Yeah. It's creative minds are where the value is added.
And with just taking a step back onto the kind of the office assets, are you seeing that own occupier piece also in office, or is that more the investor? Oh, okay.
Yep. Very, very much. Owner occupier is underpinning a lot of the suburban markets.
Wow.
Again, I think it's shoring up the occupancy cost. Really, that's been the big lesson over the last 4 or 5 years. That and the fit out. I mean, you can't escape the cost of fit out now. And office or medical or any of the specialised fit outs that we're talking about, costs are exponentially dearer than what they were.
Okay.
Syndication, something that I thought might be a good sort of thing in that space. We're seeing that that mitigation of risk perhaps across purchases where you might have 2 or 3 tenants, or maybe even 4 or 5 smaller ones, and you're not going to probably lose them all at once, and there's a bit of risk mitigation there. And we're seeing far more syndication of buyers where it's not just Mr. and Mrs. are coming to purchase it, it's actually 2 families or perhaps 3 business partners, more than we've ever seen. So
does that allows them to maybe
borrow
move
a bit
up,
more.
move up in
Correct.
terms of that.
Yep.
They're getting stuff that was out of reach for sure, but
Yes.
it's fun to do it with the team.
Yes.
There's that risk mitigation and ability to achieve your financing goals as well, because if you are borrowing money.
Well, particularly if you're moving into multi-tenant arrangements as well. It sort of softens the blow if you lose one.
Yeah, for sure.
So they're able to look, and they're looking for those kind of value add. Like we always like to talk about what are the opportunities. So the opportunities in this market is, well, we did talk about kind of that smaller end of the market, that 0 to 3 million space, still trekking along quite well, and the yield doesn't always necessarily reflect, particularly with the owner occupiers, that the prices that they're achieving. But those kind of vacant assets across any asset class really in your markets, they really show good value. Maybe if you're looking at you know, what's going to happen down the line. Like you said, that whole, okay, what's next for this asset? And, you know, maybe those syndicates or those groups of people coming together and maybe buying a little bit, might be moving up the risk curve, but there's probably some value buying still maybe in some of that space, or not really?
That's all a yield is, isn't it? It's a reflection of risk. And if you want a higher yield, then there is a greater risk. But if you can mitigate that risk through your partnerships and your strategy.
Or your skill set.
Skill set, yeah, absolutely. Or the right agent.
Yeah. Yes, yeah. Don't underestimate the value of that.
And management, of course.
Yes, yes. And that's, I mean, that's a key thing we see all the time, you know, particularly with properties that have had long-term owner management. Just the little pieces along the way that get missed around outgoings recovery, correct rent increases.
Have you ever taken over a management that was self-managed that was done perfectly?
No.
No.
No. No. And it's surprising how much value is left behind by not doing it properly.
And even the actual asset value itself, I mean, to get it done right increases the
overall value.
The book value.
Yep.
It's not just the rent. It's the security. It's the if they wanted to go and refinance it. It's everything.
Yeah. It's a bit of a minefield. So it's a relatively small price to pay for that professional service.
We talked about those kind of traditional asset classes, and we did touch on medical, but I might just kind of throw out some childcare. That was obviously a real asset class of interest over even 10-year period. Often you can get those still in that kind of lower price point. And well, I know in some markets there's been a real kind of decline in investment activity. We definitely have seen yields adjust in the current time. Have you had much activity on the childcare space, or?
No, they transact very rarely. You know, our core markets are all established areas, so the opportunities are pretty slim there. Where there is an emerging pocket in the southern end of Redlands in particular, there is a real appetite for new sites down there. Hard to get, and you know, very much in demand. People are paying what it costs.
Oh, wow.
But I think it's the interesting shift, though, is that it's moved from a big land-based model to a smaller land-based but multi-deck. So construction costs have increased, rents need to increase. It's a bit of a trickier model now than I think it used to be.
With the multi-deck stuff too, I mean, you go from sort of maybe 30, 35,000, 28,000 perhaps per place to, you know, 40, 45, 50,000 per place, depending on how much concrete you need, underground car parking, lift access for disability. So back to the fit-out conversation and the construction costs. You've then got you're into something for a $3 or $4 million land purchase, then you're into it for another $4 million build costs, and then all of a sudden that market becomes more and more shallow. You've got to make sure you get the kids, and we manage several centres, and the amount of DD that the purchase, it's a highly specialised. The guys that play in that space, they've got algorithms and overlays to go, how many places do I need? Is the market oversaturated?
And what's the daily rate that's got to be paid for the level of care?
It's nearly analytical now, Vanessa. It's gone away from that smells right, I'm going to do it because I'm a real estate guy, I know what I'm doing. Now you can punch it into spreadsheets and it will nearly come out with numbers down the bottom, and that will determine whether that's going to be a viable site and whether it's saleable down the track if you wanted to offload it.
Also, I think with childcare, it's so location sensitive.
Absolutely.
Because, you know, the number of children or the kind of the makeup of the heritage of people that never live in an area. They
the
may
suburb,
the suburb, the demographics
suburb.
does change things a lot, and also obviously competition and what's happening with population. So yeah, I think childcare. Well, I think blanketly a lot of people were jumping in and looking at childcare. That certainly has come back, and there's a little bit more kind of considered approach towards that, looking at those really kind of micro fundamentals, I suppose.
Well, a lot of them were really long leases, right? Because it was such a specialist build.
Yes.
So by virtue of the long lease, it looked like a really attractive.
But time has passed now.
Yeah.
Like a lot of those leases are coming up to like maybe their option period.
We have two of them right now, and it's a lengthy discussion to try and understand what rent's going to be viable for the tenant to maintain a business and enjoy that business, and an owner that's running a far higher sort of cost of ownership, which is probably fundamentally what the game is. But it's they do cap out. You can't just go indefinitely and get more rent, and that's you know, it is a real balance. And then there's the government factor and the subsidies that are involved. They're highly balanced. There's a number of layers to it.
A lot of moving parts.
There really is.
So where do we think this sector is going to go? Are we going to continue to see this activity in this smaller end of the market fine with like you said, deep pockets. There's money out there to be looking for a home. Interest rate movements. Who knows where they're going to go? The expectation is down at some point. So do we still think that we're going to see this? It's a part of the market that's always actually performed well.
It's
There's
always
a lot of
active.
churn. There's a lot of churn going on. So there's probably not much change.
I don't think it's particularly volatile. The construction costs seem to have levelled out a little bit. The land supply is what it is. So, I think the price points will sort of flatline for a little while.
Yes.
Demand is still reasonably robust, so I don't think we're going to see much change, to be honest.
I'm inclined to agree. I think I'd actually prefer a market that's somewhat showing stability in that sort of lending space and cost of transacting. I don't really want interest rates to do this. I mean, not in a negative way, but it's kind of, you can forecast that's the cost of doing that deal. Perhaps they come down a little bit, but steady as she goes. As far as the sort of saying in our business at the moment is, there's always someone trying to get out of that asset and get to the next one, and there's always someone who's got a bigger one who's liquidating some money and perhaps moving some money between the family, and they'll move into that space or divesting out of residential. So I couldn't agree more.
So I might end on, I didn't tell you this, so we'll just end on it and see where we get to. I think we'll start with Ryan, because Ryan kind of started the conversation a little bit. So you've got money to spend.
Yep. Not enough, but
Yeah, but like where are you looking for those value add? What is the opportunity for someone looking to invest in that kind of sub 5, sub 3? You named the price.
Yep.
Where do you think that is?
Let's call it sub $2 million, and even sub $1.5 million. It's a space that I'm personally very passionate about, because I think that for the first time, no, that's not true. It's something that for the first time there's been a great reason to get out of perhaps the residential space and into the commercial space. There's still great buying in terms of price point, and being able to work with, whether it's an agent, whether you want to do it yourself, I don't really mind, but the ability for you to have a material impact on the value of that property by putting some thinking to it, moving the use away from, for example, it's a retail clothing shop that's performing poorly, perhaps that tenant's finishing up, and go in there and repaint it, put in a grease trap for $10,000 or $15,000, put in a canopy, move it into a food use that's going to benefit from some of those takeaway businesses we spoke about earlier. That's nothing but the owner getting in there and getting their hands dirty, doing some work. Real estate requires work. Real estate requires foresight. Real estate requires you to have a go. Risks are there.
Yep.
But I think that sort of, $500 to $1.5 million retail shop, older industrial facility with a bit of a poor quality roof, get in there and get your hands dirty.
And reposition those assets.
Correct, yeah. You have to get in and have a go. Maybe it's a rezoning, maybe it's a change of use. But we're seeing it, and I'm personally doing this in my own world, is that that's where I believe the opportunity is for your everyday investor to go in and have a material impact on the value. That's what I think the opportunity looks like.
Yeah. Nathan?
Look, honestly, I love industrial stock. It's robust.
Who loves a shed?
It's bulletproof, sheddy at heart.
Yeah.
There's very little that can go wrong with them, and we're manufacturing less and less in this country, so the demand for warehousing as population continues to grow is just going to continue to increase. So I don't see any real softening in that space. I think, it goes back to the old position. You look for product that is well located, would have every attribute that you would want if you were going to put your own business in there as a tenant.
I think that's what a lot of people kind of don't think of necessarily. When the market's running hot, we saw a lot of people move away from that. But I'm a very firm believer of, if I was going to operate my business, would I want to operate out of this?
And we're all actually, most people have got a fair bit of common sense, right? So just look at something. Would I put my own business in here? Can a truck back up to it? Is there plenty of parking? Is there reasonable amenity around it? Is it close to transport routes? And ultimately, you pay a fair market cost for good real estate, and take a longer term view of it. Hold it.
That's a good point, isn't it?
Time
It's
makes
actually,
it better.
you need to sit there and commit to a journey.
At that price level, you're not really an in-and-out trader.
No.
You're a longer-term holder. The in-and-out traders are happening at a much higher price point.
Yeah.
Unless you're getting in and getting your hands dirty, as I mentioned, and actually having a material impact.
Yeah.
Yeah.
Just to not take credit
No,
on
no,
what I
no,
was
no,
going for.
no. But no, I understand that point. But yeah, I think for a lot of people, if it's entry level, just look for something that's robust and simple that you can understand, and then be prepared to ride it.
And you'll find a tenant if that one moves out,
Yep.
and it's
Yep.
always been a good spot or continue to be a good spot.
Yeah.
Yep.
I think some
That's real estate.
Yeah, some wise words to end our discussion today. We've gone a little bit over time, but hopefully we've all enjoyed this discussion. I certainly do think that kind of smaller end of the commercial market will continue to tick over. There will be activity. So anyone out there looking to invest Queensland and in Melbourne, hit up Ryan and Nathan. But thank you so much everyone for joining me, and thank you for joining us today. It was really great insights and a
having
great
us.
chat.
No, it's been great to catch up.
And thank you everyone for joining in. You can always share this information afterwards. We'll send out some information about where you can find it on YouTube. The links will be on Spotify as well, so you can go back and listen to this and all our previous episodes of Between the Lines Live. But otherwise, have a great day and we'll see you next time.